Jill Carey Hall, Bank of America, head of small and mid-cap strategy. Jill, you never have something not nice to say about your beloved small cap, so this really caught our attention. But the yield curve, you think is a big threat? Explain.
I do think it's an incremental risk, and we saw the yield curve invert, then turn back positive. Obviously, there have been instances historically where we've had false signals from the yield curve. So a lot of debate right now around what this signal is telling us. Usually, more often than not, it's a long lead signal that can indicate a recession is coming. So we have usually seen, even though small caps tend to be up in the several months following the yield curve inversion, they tend to underperform large caps during the full period of yield curve inversion, usually if that does lead to recession. So I think that what we're watching is what are the other data and indicators telling us right now. And so based on the amalgamation of inputs that we're looking at, we would still stay near-term positive on small caps over large caps. We've had a more tepid outlook on the equity market this year. 4,600 is our call on the S&P for year-end. But we still do think domestic small caps, right now we're seeing momentum in the services recovery based on consumer activity data. That should be a big tailwind for small. Valuations mentioned earlier, how much of these risks are already in the prices that you're seeing small caps really discount a lot of the risks. But we are watching a number of indicators.
They're 18% off the highs, where I'm looking at the NASDAQ, down 14% off the highs. S&P's only down 7%. So clearly they've gotten beaten up a little bit harder. I would think they're also pretty immune from the strong dollar, which is a big threat to the multinationals. Talk to us about where valuations are, given the fact that they have underperformed.
Yes, I mean, relative small caps are the only size segment that are trading cheap versus their own history on forward PE. And then relative to large caps, we're trading, below COVID and prior crisis lows. We're trading at the lowest relative multiples ever that we've seen outside of during the tech bubble. So, a lot of the risks have been reflected in valuations. You've seen those multiples compress a lot. Usually when relative valuations are at these levels, it's been a good historical long-term signal for small versus large. So if you do have a multi-year time horizon, we think this could be a good period to invest in small over large. But in terms of the macro indicators that we're watching, we're looking at ISM and PMIs. So certainly the tick down in the ISM is one risk to monitor. Meanwhile, the market PMI actually increased in March, and that one's been a little bit more correlated with small caps recently. Services recovery, pricing power. We have seen more evidence of pricing power from small caps as of the latest earnings season, and we've seen that historically. Small caps tend to fare well in inflationary backdrops, so that's something to keep an eye on this earnings season as well.